Hey everybody, it's Chris with Life 180, and I am back here with Cole Snell from Life Tech Financial up in Canada. And today's video is going to be fun, and we're going to be talking about whole life insurance as a hedge. Cole and I, we get on here, we're doing these, and I'm going to be straight up with everybody. We don't come into this thinking like very far in advance, like let's talk about this. We literally get on and talk for a couple minutes on Zoom. And we're like, hey, what do you want to talk about today? And this just happened, and I'm just being real. So like this just happened, and we're like, oh, this could be fun, and because the idea when we talk about whole life insurance being the and asset, it's not rather than an either or conversation. I was actually just talking to a person like an hour ago where I was saying, you know, nobody wants to think about putting $1,000 a month into a whole life policy for the sake of it, right? But when you realize you're not just putting $1,000 a month or 12,000 a year or 20,000, whatever that number is, into a whole life policy for life insurance, when you look at all the benefits that come along with it and the liquidity of the money and the leverage and everything that goes along with it, you know, it becomes kind of a no-brainer when you compare it to any other fixed asset, any other savings vehicle in the market. And I truly believe if everybody in the world understood what Cole and I knew, you know, the world would be a different place because everybody would be doing this. And, you know, that's a different video, I guess. But the bottom,
that's a different but necessary video.
Yes. But the bottom line, you know, Cole was like, why don't we talk about life insurance as a hedge? So Cole, I'm going to let you start this, and then I'll chime in.
Okay. So really, so thanks.
You got it.
My name's Chris. I'm the host of Life 180.
Yeah, exactly.
I wish in my dreams. So you mean, think about it as just managing downside risk at the end of the day, right? So we know where life insurance is going to go in what direction, right? We know where life insurance is going. It's predictable. Yeah. Do you know what your other investments are doing? I mean, it's really the only kind of, if you want to call it investment, let's just kind of go with that. Whether I personally agree life insurance is an investment or not is a different conversation. But let's just say for today that it is an investment. Do you know where your investment's going? Would you like to know where your investment's going? I mean, obviously the answer is yes. So life insurance as an investment, do we know where it's going? Yes. Cryptocurrency as an investment, do we know where it's going? No, really. I mean, we know.
Well, I'll say this is like, I always tell people life insurance is not an investment. If you're looking to invest in life insurance, you're thinking about it the wrong way, because the foundational concept of an investment entails that it has risk associated with it. And the only risk that your life insurance strategy has is you really screwing up in a really, really bad way, or having a bad advisor and not doing what you need to be doing. Or maybe I would say the only risk that I see people have is when they really overextend themselves and commit to a premium that is so far above and beyond what they can really reasonably afford.
Right. Poorly designed policy.
And then they design the policy so it doesn't have the flexibility that they need when they need it. That can be a risk, but that's only a risk based on working with an advisor that doesn't know what they're talking about ultimately. Right. So when you put your money in a whole life policy, we can call it a hedge because it's guaranteed. Right. Whereas cryptocurrency, even real estate, as much as I love real estate, is, you know, there's risks associated with any type of investment, right?
Right. So there's downside risks. I'm going to identify two risks. There's downside risk, and then there's risk of missed opportunity, which is, so people understand downside risk. People understand loss. People understand investing into, say, Bitcoin over the last year and having a great run, and then in the last couple of weeks, you know, the bottom dropping out of it. So people that lost 30% or 40 or 50% of their, you know, Bitcoin investment understand the downside risk. People don't understand opportunity cost. And so is whole life insurance a hedge for downside risk? Say, if you're a Bitcoin investor, just to use that as an example, and is it a hedge towards opportunity cost? The answer is yes and yes. So let's just think about the numbers of, say, Bitcoin. Let's say Bitcoin lost 40% in the last 3 weeks or 2 weeks or so.
Hypothetically speaking,
if it lost that amount in the last 2 or 3 weeks, but you lost, say, 40.
Yeah.
Your life insurance policy is, say, annually growing at 6. Over the course of the year, would you be better suited to lose 40%, but yet still gain 6 if you were looking at it as an and asset? So your money first goes into a life insurance contract, comes out of the life insurance contract, goes into your Bitcoin. So are you using life insurance as a hedge if your 40% loss is now a 34% loss? And would you take a 40% loss over a 4% loss? Well, no, you'd take the 34% loss if you could, versus and that only exists because you're leveraging out of a life insurance contract. You're not using it as an investment. You're using it as a bank, a storage capsule of wealth or capital. And then you're moving forward to make your investment. And your risky Bitcoin investment out of that.
And check it out. Like, I think most people, just in the Bitcoin example, I look at Bitcoin as it's kind of like a winner take all kind of game. It's either gonna work or it's not, right? Like and there's really not much in between range, in my opinion, as far as Bitcoin goes. I mean, I guess there's always going to be a community of people, but it's a winner. You know, it's gonna either work or not. So like, imagine you bought Bitcoin at 60, and let's say you bought 60,000. You bought one Bitcoin for 60,000 bucks, and you took a $60,000 loan from your whole life policy to do so, right? Yeah. You know, you borrowed against your policy to get the Bitcoin. The Bitcoin drops to 35,000 hypothetically. That would never happen, but let's imagine it did, right? And so now you're like, oh crap, I just lost, 40% of my investment. But the reality is you're not going to sell. I mean, I hope you don't sell, right? Like, just, if you bought it at 60, you're in for the long haul. I'm sorry, but like, if you bought it at 60 and you're not in for the long haul, you made a huge mistake, first of all. And I would really coach you to make sure you're going through different processes before you make financial decisions like that. But at this point in time, if you happen to be watching this somehow and that's you, like, I would say you just got to ride it out, eat it, because I do believe in Bitcoin. I do believe it will come back, and I do. Sure. It's the cycle of things, right? But think about this. Let's say this. Now that Bitcoin has lost 40%, this is the average versus actual. Let's say Bitcoin went from 60% or 60,000 to 30,000, just for easy round numbers. So that means Bitcoin lost 50%. Well, now that it's at 30,000, to get back to 60,000, Bitcoin's got to go up 100% in value just to get where we are. So let's assume, and only in the world of Bitcoin can we talk about numbers like this, but let's assume this year it lost 50%. Next year it goes up 100%. I think there are a lot of people out there that could be like, yeah, that's probably going to happen, right? Like, I mean, it's within the realm of possibility. Reasonably.
It's happened already.
It's happened already, right? Yeah. So let's say it goes back up to 60,000. Well, what's your average rate of return? Well, most people would say it's 0, but no, that's your real rate of return. You had a negative 50 year. So that's horrible. And then you have a positive 100 year. Well, you got 100 minus 50 is 50 divided by 2 years. That's a 25% average rate of return. That I actually just did a video on average versus actual rate of return a week ago, maybe. But at the time we're filming this, but the bottom line is when you get back to 0, you have a real rate of return of 0. But the cool part is, even if it takes a year, if it takes 2 years or whatever, the money that you borrowed against your whole life policy, or like to get that Bitcoin, you can pay that back, all the while the capital account, your whole life cash value, is still compounding at whatever the dividend rate is. Let's say it's 6% hypothetically. If it takes you 2 years, well, year 1, that's going to go to up 6%. Year 2, that's going to compound, go up 6%. So when you pay back the loan, and you pay back the Bitcoin, everything, whatever it is, you use what it got back to good. Even though you may not have made money with Bitcoin, your cash value is actually gone up. And so that's kind of a way of hedging as well. You don't have to get back quite so much to just break even. You can get back that much and actually earn money.
So you just coined the title for this video, which should be the best way to borrow money to invest into Bitcoin. What is the best way to invest into cryptocurrency? The life policy loan is the answer.
Yeah. I mean, listen, I say it all the time. You're never going to get wealthy without taking risk. Do I think Bitcoin is the place to get wealthy? Personally, for me, no, I don't. Are there people out there that believe Bitcoin, or that are capable of making Bitcoin their way to get wealthy if they're great at trading and they understand the markets and all that? Yeah, there are. It's kind of like, what's the value of a golf club? Caleb talks about this in his book, right? What's the value of a golf club? Well, it depends on how good with that golf club you are. Like, value to a golf club for me is an expense of about $200 if I'm, buying a good set of golf clubs. The value for a golf club for Phil Mickelson, who just won the PGA championship at 50 years old, he's made it's an investment for him. A good golf club for me is an expense. A good golf club for him is an asset, right? It's an investment. And so like you have to pick what you want to do. But if crypto is your thing, it doesn't matter. What I love about whole life insurance is it just maximizes your ability to show up more powerfully in anything that you're doing. And whether it's your business, real estate, crypto, whatever, like crypto, day traders, this is another thing, is like, you're taking risk as a day trader. Like, they're dealing with money in and out, in and out. If you had a way that you could take money, put into your trading account, try to earn money, pay back the policy loan, but you never interrupt the compounding of the money that you're actually trading. While you're trading and the money is in the markets doing your thing, the money is sitting in this little side account. All total amount that you're trading and playing with is growing on an uninterrupted compounding basis in a side fund. Like,
instead of whole life insurance, they should call it whole hedge insurance.
Yes.
Because it's basically a hedge for your entire life. And the other thing that it does too is it cuts out opportunity cost. It's hedging you against opportunity cost. And opportunity cost, if opportunity cost fell out of the sky and hit the average person in the head at 100 miles an hour, they might feel it. Opportunity cost is really confusing because it's happening to people and they don't even really know what's happening. It's disguised and it's evil and it's eating away. It's eating away at you and your wealth all the time.
Yeah.
Owning whole life insurance naturally hedges you against opportunity cost. So like, I have a question for you. If you just walked up to the average, say, 20/30-year-old on the street, and you were walk up to them and say, hey, I have $10,000. I'm going to give it to you. Would you put this today? First off, you would ask them, do you own Bitcoin or do you own whole life insurance? And they said, I don't own either. Why are you asking? Because I'm going to give you $10,000 right now. Where would you put it first? What do you think the average, say, 20/30-year-old would say?
Bitcoin, 100%.
Right.
Like, it's not even close. 99.99% of them would say.
So if I walked up to you right now and I was able to say, here you go, Chris, here's $10,000. But you had to eventually invest this into Bitcoin or crypto, whatever. How would you do it? What would you just take it and give it to Coinbase or Binance?
No, it would flow through a policy.
You put it into a life insurance contract.
Yeah, totally.
And then what would you do with it?
Then I'd take a loan against that life insurance contract and I'd buy Bitcoin.
You buy Bitcoin.
Yeah.
Right.
It's the same thing. So listen to this. So this is really funny, kind of like a side note. Totally like changing directions on you here, but
you never do that.
No, I know. So I've got my trailer, my Black Series Patron trailer that I pull behind my Jeep. And my wife and I are talking about like just what we're doing with different things. And I hate spending money. That's just like a thing. And this, I hadn't used this trail. I bought it in September, and then winter in Arizona. It's nicer than everywhere else, but like, I love to go camping in the mountains. So I hadn't used a trailer since November, and it's just been sitting there, and it just drives me nuts to think like, I've got this asset that's just sitting there, not making anything. And I had it listed for rent because my whole idea when I bought this, cause I could never justify spending, the kind of money, taking a policy loan, buying the trailer, doing all that stuff and just having it sit there and just using it for me. Like,
appreciating too.
Depreciating. So I was like, the whole thing when I bought this, I was like, I was going to cash flow it, and I was going to create passive income. And so I listed it on this website called Outdoorsy, and it just nothing, crickets all winter. I'm like, well, this is a bad idea. Like, this didn't work the way that I thought it was going to work. Holy crap. Like, I was hoping it would rent in the wintertime, like whatever. And then literally like in the last 4 days, like my wife and I are going to Costa Rica, in June. And so we're not going to have time to go camping in June. And so all of a sudden somebody sends a message out and they go, I want to rent your trailer from June 8th to 12th. And I'm like, okay. And so bang, it was like $800 of income. And then there was another one later in June, and it was like another $1,200 in income. And then somebody wrote to me last night, I'm about to go to bed, and on the app, and they're like, is your trailer available this weekend? I'm like, well, I mean, it can be, you know, and boom, it's another $700. And it's like, all of a sudden out of nowhere, I've got this trailer, by the way, that I only, because of the fact that I had leverage and I was able to, this is the other thing, you make money when you buy, everybody, right? So I could have gone, and Caleb and I did a video on this, that there's no such thing as 0% financing. Because when you go to a bank and they say 0% financing, they just bake it into the cost of the asset, and they give you 0% financing, but they increase the charge of the thing. So when I went to buy this, the MSRP on this trailer is $30,000, $29,995, so $30,000 bucks. And when I was talking to them about it and trying to buy it, they were like, I was like, well, what can you do for me? Well, we'll knock it down to 28,000. Well, what else can you do? Well, we'll give you 5% financing, which is really good on a trailer apparently. And I was like, no. What would it be if I just gave you cash, right? They don't know how I'm doing it. They just know they're getting a check and it's cash, and they don't care, right? And they go, well, if you could pay cash, we give it to you for $19,995. So I got 33% off the trailer. I could literally just like that, you know, brand new. I had to wait a couple months for it to get built and come in and stuff, but like I got the trailer. I got to use it. And so literally this month I paid, let's think about 20 grand for an asset. It just sat there. I didn't do anything with it. Now it's peak season. $2,700 in passive income that's coming in this month on this asset that I haven't had to do anything with. And I know it's going to get better. You know, that's a 10% annualized rate of return. And, you know, you look at it, I mean, yeah, there's some expenses and stuff that go into it, but as a business that buys that, I can depreciate it as well. So there's tax advantages to having it because I own it all through the business. Life 180 actually owns title on the trailer. And so, you know, it just goes to show. And I know we were talking about crypto and hedging and stuff, but I don't know why. I think it's because these conversations are happening. Like literally last night, like these people are calling me and blowing me up being like, I need your trailer. And like, I'm thinking like all the different ways that you can leverage. Everybody is so stuck on like investing in the stock market, right? Putting their money there, oh, why would I put my money in a whole life policy? Because there's no return in a whole life policy. Well, hey, take a look at this. Where in the world can you put your money somewhere that's going to guarantee you 3 to 4% all in after all net expenses and everything in a guaranteed fund that you're going to have liquid that you could leverage and buy an asset that, by the way, increases the quality of my life, the experiences I have with my wife and kids, the relationships I have with my kids, and can cash flow at a rate that's more predictable and better than any kind of stock market investment.
Yeah. So some would say that, because you purchased the trailer from a policy, when it was sitting there not creating passive income and depreciating, was it actually, so let's depreciate it let's write it down and depreciate it at say 3 or 4%. If the life insurance contract is earning you 6%, are you actually, so you could argue that you're making money off of your own debt, right? You're making money off of your depreciating asset, because if it's depreciating or write it down at 4%, life insurance contract is going up at 4%. There's 2% arbitrage but then you have all the other things that you just mentioned. You have the enjoyment of it, the connection with your family, and now you have passive income. And so as soon as you add that passive income on top of the depreciation, it makes your decision to finance your debt through your own banking pool of capital system through your life insurance contract a really good decision.
It's the biggest. It's so awesome. And it's so cool. Like it was literally just this week where I was genuinely like questioning my decision a week ago. And I was telling my wife, I'm like, listen, we're at this tipping point where because I got it at such a good price, because I paid cash, I could literally go to the secondary market right now and sell it for 23, you know? So I was like, we're at that tipping point. I could sell it, get out of it, come out ahead still, right? So I have to make the decision. Am I going to do that? Or are we just going to try to ride this out? And it was almost like a God thing, right? Like where it's just like last week we were having that conversation, and then all of a sudden $2,700 in revenue this month, bang.
So I have clients, or, you know, I have colleagues, or even with myself, we'll often talk about, you know, how much cash value you have left in a life insurance contract, or what you have existing in a life insurance contract right now. And I talk to people and they get often stressed out. People that live and breathe what we're talking about get super stressed out about having too much cash value in their life insurance contract. It means that they're not putting their money in motion.
Velocity of money, right?
They need leveraged. And now you're guilty of opportunity cost, because when I'm sitting there with a whole bunch of cash value in my contract, I'm realizing, okay, I'm missing out on some opportunity somewhere.
Yeah. Well, so
and
go ahead. Go ahead.
Yeah. And I know I need to go and get it. Because I know that, well, how am I going to make that policy loan? How am I going to pay that policy? We did another whole episode on paying back your policy loan. I know I'm going to have to pay that back to myself, but I'm going to pay it back to myself from the passive income that I'm going to generate from making sure that I'm putting that money into motion.
Well, it's crazy too, so like it was a conversation we had. I think it was actually in one of our videos, but maybe it wasn't on a YouTube video. It was just one of our talks. But you brought up the fact that in Canada, they use third-party lenders a lot for policy loans. And so I started looking into that in the United States.
IFAs, immediate finance arrangements.
So in the United States, they call them CVLOCs, cash value lines of credit. And it's a new thing, and it's happening.
A CVLOC is a life insurance lending product.
Guaranteed and backed. I didn't know that. So banking institutions are now starting to party. Oh yeah, look into it. So I'm actually working on a video. I'm going to launch a video next week on this topic, and I'm going to give some companies. I'm doing some due diligence and trying to find some companies that look good. Full disclosure, like when the video comes out, and I'll say it there.
It'll do CVLOCs.
They will do CVLOCs. I'm going to give some title, like some of the company names. Full disclosure, I'm not personally using them or like working with them. So I can't like vouch for the institution, but they're all banks, right? They're all literal legitimate banking.
100% loan to value.
They'll lend up to 95% loan to value rate on a whole life policy. They will not lend to an index universal life policy, by the way, only whole life. Yeah. Just to remember
same as IFAs in Canada. You can't do one with.
So they will lend 95% of the cash value, and they're going to give you as low as a 2.75% line of credit. So when you're talking about the ability,
is that prime right now?
Two and three. That is just what it is right now. They're given 2.75%. It is variable, so I don't know what prime is, but right now that's what I saw. One company at 2.75. I saw one at 3. I saw a bunch of them at 3. So I don't know what the caveat is for the 2.75.
Prime's around there somewhere. Yeah.
But either way, let's say it's 3%. That's amazing. Like for everybody that has a whole life policy, that's going to have to go pay between like 5 and 8% on your policy loan right now. Go right now and reach out to one of these companies, get a line of credit set up. You don't have to use it. Just have it set up and available. Yeah. Like if
you're not using it, there's no cost to it.
Exactly.
It'll cost you a little bit of time. Yeah. There'll be some scrutiny because there'll be a credit check. Whereas, a policy loan, it's unilaterally guaranteed. There's no credit checks.
Yeah, there's some convenience with the life insurance.
There's a couple hoops to jump through, but I mean, you can go up to 95%, so you get an extra 5% out.
Yep.
And do they have in Canada, IFAs usually start around $50,000 annual premium?
65,000 is the minimum line of credit. So you need at least, I think that with that percentage, let's say you need $70,000 in cash value in your policy to qualify.
One of my all-time favorite, when you compare a CVLOC or an IFA or even a policy loan against, say, as an asset against a home. So real estate investors, we talked about crypto as an investment. Let's talk about income properties as an investment. Commercial or residential.
That's my favorite thing. That's my favorite thing.
So asset A, asset B. What do you want your asset to look like? 65% loan to value in Canada is what they'll give you on a line of credit, or they call it a home equity line of credit here in Canada. Whereas on a life insurance contract, you can get 100% on an IFA. You got $1 million of equity here and $1 million of equity here. Why would you want an asset that you have to cut the grass, fix the leaky roof, and collect the rent?
Yep.
And the bank is going to make you qualify for your own money, and they're going to give you 65% of it.
Yeah.
Whereas if you have life insurance over here, you don't have to cut the grass, you don't have to fix the leaky roof or collect the rent.
Yep.
And they're going to give you 100% of it on an IFA or 90% of it on a policy loan. So, right.
Yeah. I mean, it's definitely, your house is not a storage of wealth. It's, it can be a cash flow asset, but it's not a place to store your money. That's the biggest mistake. People want to pay off their rental properties fast. And it's like, no, you're giving up control.
Pump the whole life insurance contract and use that to purchase your passive income, your real estate.
Totally.
commercial, what have you.
Love it, man. Well, hey, I know you have a hard stop, so I want to honor that. And
Right.
I know this was a totally random video, everybody, and we just kind of bounced all over the place. We went into it with the hedge. Yeah. The hedge is the concept, and we just kind of bounced all over the place, which hopefully people found value in.
I think it was pretty straightforward. It was a hedge against your crypto investment, hedge against your trailer depreciating.
Yeah.
And a hedge, I'm giving the middle finger here.
Yeah, there you go.
Left hand, so it doesn't count. And a hedge, I'm giving the middle finger to a hedge.
Nice. There you go.
Opportunity cost.
Yes, exactly. There you go. Perfect. So anyway, guys, if you found value in this, hit that like button. Make sure feel free to share this out if you think anybody would be entertained by it. If you haven't already, subscribe to the channel, click that bell. That way you get notified every time we launch a new video. Cole, as always, a blast. Guys, have a blessed, inspirational day, and we'll see you on the next video. Take care.